Hey, so this will be the final video in my ASC 606 series. This is the high-level overview of steps 1 through 5 and some detailed considerations that I think you'll find are helpful. And so if you have any explicit questions, just subscribe or write in the comments below explicitly what your question is, and I'll do my best to answer them. So today I'm going to be talking about step 4 and step 5. So that's allocating to the underlying performance obligations, and that's recognizing revenue after. So step 4 is allocating, step 5 is recognizing revenue. So overview again, right? We've already identified that we have a contract. We've concluded on the performance obligations in that contract and determined our transaction price. Now we're taking that transaction price and we allocate it to the underlying performance obligations. And so the reason I'm combining these concepts is because this step is really a mathematical exercise, but there are some nuances to it I just want to highlight. And so we look at this concept called standalone selling price, also known as SSP. And so what we're going to do is we're going to look at all of our products that we've sold in the past, all our performance obligations, and then we're going to look historically what we have sold them for in the past. And then we're going to find a range or a specific point that we are selling our products for. That will be our standalone selling price. And so a range is appropriate. So example, if we're selling bikes and the bikes range anywhere between $400 to $500, depending on the time of year we're selling them, that would be appropriate to say the standalone selling price is between $400 and $500. You could also just say it's a point, like the standalone selling price is, let's say, $450. You just take the middle point. And those ranges and percentages can be altered and adjusted depending on your line of business, as long as it's a reasonable range and you have evidence looking historically on what that standalone selling price concept is. And then what you're going to do is you're going to take that standalone selling price of your performance obligation, you're going to plug it, essentially after you've determined it, you've had historical compliance that yes, you've sold a lot of these products within that range or at that point, and then you're going to plug it into your formulas along with all of your other performance obligations in order to help you figure out how you're going to recognize revenue and allocate using something called a relative selling price model. And so that relative selling price model is where you're going to take all of the different SSPs of each of your performance obligations, the quantity of how much you're selling, and then you're going to allocate the transaction price in proportion to the total SSP based on your relative selling price allocation. So let's say you have two different bikes. One has an SSP of $450. One has an SSP of $300. You have a cheaper bike and a more expensive bike, and you have a $1,000 contract price, one for each bike. You'll take the $450 and the $300, and you're going to add those up, then divide the proportion, and then multiply it by the $1,000 transaction price in order to figure out how much revenue should be recognized for each performance obligation. So you can imagine, it's a simple math exercise, but it can actually get relatively complicated pretty quickly if you have a lot of different performance obligations in your contract. Let's say you're also selling support for the bicycles. Let's say you're also have someone going out and to customize the bicycle for this individual. And you also promise trade-ins or something to that regard of some kind of warranty. That can make this a really challenging calculation to do. And so that's this concept of allocating to these underlying performance obligations. You have to figure out your standalone selling price, and then you're going to allocate. And the second concept is, this last concept, step 5, is recognizing revenue. And so when we're recognizing revenue, we have to figure out, well, is a performance obligation satisfied at a point in time or over time? That's really the crux of it. It's not as simple as you think. So let's say you're delivering that bicycle, and that bicycle is, let's keep it simple. That bicycle you delivered, it's paid on day 1, and you have no service contract for it. Well, you probably can recognize that revenue on day 1 when that bicycle is transferred. And so this concept is like a transfer of control. Once you no longer have title to the bicycle, once you have completely transferred it to another customer, you can no longer get it back. There's no right to recall or anything like that. Then you very likely can recognize revenue at that point in time. Well, sometimes transferring control isn't that simple, right? Sometimes we might give someone a product, but we keep the title. And so, for example, if you are selling a car to someone and it's on a loan, and so you keep the title, or you have a lien against the title of the car, that question is, well, have you actually transferred control of that car, or do you have something that's not even a revenue contract, more of a lease contract? And so these are nuances we have to really consider. Or think about it this way: what if you're renting a bicycle? So you borrow the bicycle you have it for a year, you're going to spend $200 for it. You get the bicycle on day one. Can you recognize revenue on day one? Well, we have to look into, did control transfer, or is it being simultaneously granted over that period of 1 year? And if it's granted over the period of 1 year, like a rental contract instead of a lease, we might be determining that we recognize that proportionally over that year. So that's the overtime component. So we really have to be figuring out when is control transferring, and if it's transferring at a point in time or over time. And that can get very, very complicated with things like software. If we're selling a software license might be given at a point in time, but all the underlying support might be given over time. And so you'd have to proportionally allocate those concepts, allocate those performance obligations based on the transaction price, then recognize a portion up front, and then a portion, the rest of the support, that's recognized over time. And then you have to figure out, is that overtime ratably? Like, is that what's the proportion of overtime? Is it overtime based on usage? So for example, if you are using a software that charges you more for the amount of data you're using, you might have to ultimately consider that it's not going to be a prorated amount that's like straight lined. You might have to figure out the usage per month and then allocate based on that amount of usage, which can get very complicated. And so those are the big takeaways for recognizing revenue. The other major concept is this concept of principal versus agent considerations. And so what if there's a situation where you have a third party, right? And so there's this third party concept of let's say you have a friend, and that friend wants to buy something from someone else, and who's also your friend. So that someone else, that third party, and your customer, right? So your customer wants to buy something from this third party. So this third party goes to you and says, hey, listen, we'll give you a 20% fee if you connect us to. And so you facilitate that transaction. There's this concept called principal versus agent consideration, where you have to determine, well, am I just an agent? Am I just connecting these two parties? And should I only recognize 20% of the revenue, or am I actually taking on some risk? So that would be more of your traditional resale arrangement, where let's say that this third party sells to you product, you hold on to the product and hold the title and ultimate risk of loss for that product. And then you go and then you sell it to the customer, then you're a principal and the agent. If you're just facilitating the transaction, you are this is more of an agency relationship, and you'd recognize the transaction only for 20%. If you're more of a principal in the transactions, a principal to principal relationship, you'd recognize 100% and then just have a higher cost of goods sold. And so these have huge financial consequences. And so if you're interpreting financial statements, or if you are preparing them, or just advising a business, figuring out how these different transactions are structured are key to making sure that you are accounting for them correctly and providing the right level of detail and information to your financial stakeholders. So there's a lot of other concepts here. I covered a lot. We talked about principal versus agent considerations, how to calculate SSP, the concept of relative selling price analysis, and we talked about how to recognize revenue over time and at a point in time. So if you want any more details or a deep dive on any of this, just feel free to post. Feel free to add a comment after you subscribe, and I will dive into it. But it was a pleasure talking to you all, and have a great day. Bye-bye.